Hello, good morning, everybody. This will be the audience participation portion of the conversation. It's very good to see you. My name is Greg Johnson. On behalf of TAG and on behalf of Fintech South, it's my pleasure to welcome you to what I personally believe is one of the most important tracks throughout the entire conference, examining all of the topics that are at the future of finance, the future of payments, and involves some of the most important headlines developing. And I don't think it's hyperbole anymore to argue that this year has ushered in a wave of regulation, a wave of innovation that is disrupting the banking industry unlike anything in centuries. And I know that sounds hyperbolic, but it's not really hyperbolic. My lens into the conversation, both for this discussion today, which I will hand it over to our esteemed fireside chat participants, really comes from a bunch of different places. 25 years at American Express at the intersection of payments and wealth management services, crypto and digital assets through Rubicon Crypto. But I also sit on some relatively interesting places in Washington at the center of change coming from the Bank for International Settlements, the Bretton Woods Institution. So all of these themes are going to find their way into a very timely and important conversation. Speaking of conversations, there was a conversation that was, overheard back in 2016 that led to this panel actually taking place this morning when Justin Peru, the founder or co-founder Yellow Card, easy for me to say, overheard a conversation and actually was in disbelief at some of the things that he heard. And what he heard was outrageous fees for somebody to send money back home, hard-earned money back home. For those of you that are unaware, the remittance industry is a very, very large piece of not only the U.S. economy and the banking and payments economy, it's actually almost 1.9% of global GDP in 2023, which includes the volume of money exchanging from one place to another, as well as all the services that go into it. And for far too long, that industry has been locked down by incumbents. And this gentleman has been doing an amazing job of opening that up with on-ramps and off-ramps, specifically focused on the continent and now expanding elsewhere. So Justin and Dennis, I'll cede the floor to you. And good morning, everybody.
Thank you. Thank you for the warm introduction. For those of you who don't know who I am, my name is Dennis Owusu-Sem. I'm the Chief Operating Officer at This Week in Fintech. We're the world's largest fintech publication. We have over 200,000 global subscribers. And we conducted the world's largest stablecoin conference in May, and we're looking to scale that up next year. So pretty timely in terms of the introduction. I'd like to think that we're in the stablecoin summer right now. There's a lot happening. It was probably kicked off by Bridge's acquisition by Stripe, and obviously the legislation taking place. We've come a long way since the Wild Wild West days. From your perspective, what's been the biggest misconception that people still have about stablecoins to kick us off? A hot take.
Yeah, I would say that there is this kind of branding issue that stablecoins may kind of suffer. And I think the biggest kind of takeaway is that, stablecoins are built on the same technology as, say, NFTs and DeFi and that kind of technology. But they're fundamentally different in the fact that stablecoins aren't a speculative asset. They're stable, right? They are pegged 1-to-1 with the U.S. dollar. And now thanks to the Genius Act, which I'm sure we'll get into, we know that for every dollar of stablecoin that's in circulation, there's now $1 sitting in an audited bank account or a treasury bill. And so essentially what we're seeing now is stablecoins aren't NFTs and DeFi or even Bitcoin. They're an extension of the U.S. dollar.
Interesting. You touched on the Genius Act. In 2 sentences, what changes now and why does that matter to people?
2 sentences, that's tough. All right. I would say, you have CFOs and treasurers and CFOs all over the world that have been watching this technology kind of skeptically. And they can see what it can do in terms of being able to facilitate cross-border transfer and supplement books. However, it's been kind of put in a risk class where it hasn't met necessarily the that hasn't had the level of clarity on the regulation side. And now with the Genius Act, there is that clear clarity, and it is now essentially de-risked in the eyes of a lot of these CFOs and treasurers. And what we're going to see is a massive movement of stablecoin as it gets injected into the books and back office kind of movements of a lot of these institutions and enterprises in a way that we have never seen before.
Very cool. I know we rushed ahead, and now that we set the scene, I want to kind of go back and zoom into you personally. I know Greg touched on it, but let's rewind to the beginning. What was the turning point that convinced you that stablecoins were the right infrastructure for solving the remittance challenge?
Yeah. I'll take us back to the story that Greg was talking about earlier, where essentially we were trying to start a gift card for the U.S. market. Buy your techie nephew or niece a $50 gift card worth of Ethereum or Bitcoin. You can imagine on a CVS gift card rack. And as we were building this out, we met a Nigerian man in Auburn, Alabama, of all places, that was sending $250 back home to his family. And we overheard him talking to the teller, and he was saying he does this every month, and every single month they're charging him a $90 international wire fee. And for that family to be losing that amount every single month just didn't make sense. And at the time, building out this kind of a gimmicky kind of Bitcoin and Ethereum gift card product, we realized hey, Bitcoin can actually help facilitate this cross-border transfer or this remittance. And so we ended up sitting down with the man, kind of teaching him about Bitcoin. But then later we were thinking, what is this family? Yes, we can help this man transfer this store of value, i.e. Bitcoin, from Auburn, Alabama to Lagos, Nigeria. But how is the family in Lagos going to actually extract that buying power from it? How are they going to buy goods and services with this Bitcoin? And then on top of that, while it's sitting, while the family's trying to figure out how to actually use the Bitcoin, what happens to the price fluctuations? How does that impact the family? And so ever since then, we've been trying to really hyper-focus on answering how does that family actually extract that buying power, across Africa, right? Being able to send and receive money, whether it's Bitcoin or stablecoin, and be able to essentially swap between them freely, on and off ramping. And then B, and to answer your question, stablecoin answers what about the price fluctuations, right? Stablecoins, considering they're built on the same tech, are able to now flow freely, and then here at Yellow Card, we're able to on and off ramp, from stablecoins into local fiat. And so now what we're seeing is, we're helping, say, PayPal Zooms, their expansion across Africa. They have their own stablecoin, and now, we've essentially been able to answer that original, problem that we were seeing in Auburn, Alabama, where now that man could go onto Venmo, go onto PayPal, acquire PYUSD, which is PayPal stablecoin, send that to their family in Lagos, Nigeria, and they can instantly swap that to Naira, using Yellow Card, really kind of tackling the cross-border and remittance problem head on, and it's powered by stablecoins.
Very cool. I know you touched on the whole Lagos piece, but remittances are big in Latin America, they're big in Asia. Why Africa? Why did you choose to center your operations in Lagos rather than any other African countries? And for context, I'm of Ghanaian heritage, so I'm a bit like, why with the Nigerians?
Oh, yeah. Just the jollof in Nigeria is just better.
Exactly that. Ours is better.
I'm just kidding. Essentially Africa firstly, and then specifically Nigeria, is essentially a perfect case study for the power of stablecoins and, the power that the technology can bring. Firstly, starting off on, actually seeing that example in real life and seeing that problem firsthand with the man sending to his family back home. But then past that, we are seeing unprecedented levels of adoption of not just stablecoins or in crypto broadly, but just technology. Nigeria in particular has such a young, raw talent that is very quickly adopting, new technologies, to the point now where a recent Chainalysis report has Nigeria as, I believe, number 2 in terms of stablecoin adoption behind India. And so it's just the perfect, essentially, case study for us to build and, build where we can have the biggest impact.
Very cool. Let's fast forward to today. What does Yellow Card actually look like in the hands of users? Like, who are they and what are they actually using it for on a day-to-day basis?
Yeah, so we are a global stablecoin platform and infrastructure provider, which is a mouthful, but essentially what that means is we are enabling businesses from around the globe to be able to execute on their stablecoin strategy. So that means if they need to be able to make and receive payments across the emerging world without having exposure to local fiat currencies, or they need to be able to repatriate funds and collect funds from all these different countries, they're able to facilitate that through the Yellow Card platform and our infrastructure. And so we have essentially two archetypes of customers. One, which is like a PayPal, Zoom, or a Visa that we're working with to essentially help facilitate their expansion across Africa, being able to send money back to the United States or repatriate funds back to the United States without all of the points of friction and hassles that are often associated with building a business across Africa. And then the other archetype of customer is those across Africa and emerging markets who are trying to expand their operations and really be able to not just be stuck in one country, but very, very freely open up their operations in other countries and be able to manage their positions and local currencies, be able to access deep liquidity pools, and essentially be able to on and off ramp, make payments, make cross-border transfers all through our systems.
Very interesting. I know you seem to have quite a lot of customers from Visa to people using it day to day. And from my research, you've got 20 markets, 20 different sets of regulations. What's been the hardest market to crack in your experience and why?
I wouldn't say it's necessarily one market in particular, but it's more so cracking our approach to working with so many different regulators and so many different systems. I would say generally for every country we operate in, it is just a completely different culture, different financial system, different regulator that we've had to have a real local first approach. And so on the regulation side, we always try to be very upfront. Here's what we're doing. Here's the information that we're collecting. Here's the features that we or the functionality that we provide. And then on the technology side, being able to take into account local nuances. Like something that comes to mind often is when trying to build systems to say talk to local bank accounts, trying to validate bank account numbers. It seems really simple, but in some countries, say Tanzania, for instance, your bank account numbers can have letters in them. And so, having to build for all of the local nuance, all of the kind of friction points that often exist, in emerging markets, has been the kind of overarching challenge.
And so if you had a magic wand and you could solve one infrastructure challenge, or someone could solve an infrastructure challenge for you, maybe it's a good business idea, what would that be and why?
I'd love for someone in the room to solve identity across emerging markets. That in itself, especially operating a financial technology platform, it's a problem that you're constantly having to battle, particularly around fraud and ensuring that you do know your customer, you do know your business that you're transacting with. And in a lot of cases, particularly the emerging markets, a lot of identity systems provided by the government, are defrauded. You can pay someone to generate the equivalent of Social Security numbers in a lot of these countries. And so then how do you actually verify identity then? Well, you have to build out redundant systems and fingerprinting and, use external resources to try to actually ascertain identity. And, me as a co-founder, that's not what I want to spend my time and resources on. I want to build out, what we're actually trying to achieve here, not have to invest so much into, proving identity.
Let's go back and double click on something that you mentioned before. Let's go to the people on the ground. We know the stablecoin adoption in sub-Saharan Africa is nearing 10%. And with Nigeria having 26 million users alone, what do you think are the core factors that are driving that traction? Yeah,
so on the retail side, I would say it is predominantly savings and payments. So, people are turning to stablecoins as a hedge against local currency devaluation. If you're a founder that's raised money, you don't want to be subject to currency devaluation. If you're a business owner, You don't want to have to worry about constantly having to take into account their fluctuating kind of currency, especially when it comes to importing and exporting. And so, hedge against inflation. And then I would say on a bigger scale, cross-border transfer is the bigger thing. If you're a business owner, in many countries, many banks have lack of US dollar liquidity. So if you're trying to actually, import parts from Southeast Asia, or China or Japan, you are limited by the amount of US dollars that your bank is able to actually access. And so in a lot of cases, you may be limited to $200, $300 worth of imports a month because your bank literally does not have enough US dollar. We work with one company that before they started working with us at Yellow Card, they had to give their bank a month's heads up in order to make a $10,000 payment. And so it was just constantly cycling where they are capped in terms of their own growth because of the amount of liquidity in the bank. And so this is where stablecoins really become that almost bridge where it is now enabling them to cycle their money faster, be able to make those same payments that they would normally be restricted, which essentially has a direct correlation to them being able to grow and scale their business. They're not limited to $300 worth of repairs a month now. They can, grow and scale freely.
So from those three use cases, savings, cross-border, remittances, where's the most of the value lie?
I would say kind of cross-border transfer and remittance. And that's what we're going to see in a bigger and bigger scale, while also providing on the retail side savings, and access to US dollar savings account essentially. But I think the big kind of widespread impact is going to be when we have all of these central banks and these large-scale institutions like Visa and MasterCard getting deeper into the stablecoin space and making essentially capital flow more efficient globally. That's what I see stablecoins having the biggest impact on.
And in terms of the users, have you received any feedback that's reshaped your perspective as to how you're building Yellow Card?
Yeah, in the early days, we were actually shocked. We'd never thought about businesses when building Yellow Card transparently. We were trying to be essentially the Coinbase of Africa, the go-to spot to be able to buy and sell Bitcoin, across multiple jurisdictions in Africa. And what we saw over time was that as stablecoins gained, popularity back in 2018 and 19 when they were first kind of coming onto the market, we saw our volumes dwindle from Bitcoin and continue to skyrocket on USDT. And so we started to double click into the why. We kind of assumed people did like the speculative nature of Bitcoin. But no, in fact, it's businesses. Double clicking into the reason why there was such a big shift in volume is because businesses started actually using it to facilitate their own payments, for their own imports and exports and as a hedge against currency devaluation. So that was a fascinating, eye-opening experience for us.
Very cool. It's clear that stablecoins are like shaping real lives, but with scale comes trust and regulation. With the Genius Act passed, how do you see this impacting the flow of money between the US and Africa, given the changes in AML requirements and KYC requirements as well?
Yeah, I think a lot of countries and regulators globally look up to the United States as an example. And now that we have the Genius Act in place, there is this, at least anecdotally, in my experience, a new level of comfort when it comes to stable coins. And kind of what I was saying earlier is I think we're going to see a significant de-risking in the eyes of many CFOs and treasurers on this financial instrument. And so what that's going to lead to is deeper integration from central banks and from large-scale institutions that are needing to make their capital more efficient. I would say broadly the way that I'm thinking about it is kind of what email did to letters for business. You used to be able to, or you could send a letter and it would go through several postal services and then finally reach the end destination after many days and you panicking, wondering if it's going to make it. Email made it to where from sender to receiver, it's there. It makes it happen, or it is received instantly. Then on wires, it's very similar, right? If you send a wire, it's bouncing through correspondent banking. It's going through several hops. There's many delays. That makes it expensive. Whereas stable coins, kind of similar to email, is just from sender to recipient. And it's essentially just going to connect the world together and make money flows more efficient.
You were the first licensed virtual asset service provider in Africa. What did you learn about building regulator trust through that process?
Yeah, 20 different jurisdictions, 20 different regulators. I think one of the biggest eye-opening experiences with us is that we could not take a one-size-fits-all approach. You have to take a local first, regulator first, approach where you're being upfront, you're being very transparent, you're recognizing the local nuance and the local systems at play, not just coming in and saying, hey, we've got the solution, here's what this should look like. It has always been more of a partnership with each of the regulators that we work with, and that's led us to, pretty big successes and actually able to replicate our own work, say in Botswana, where we received the first virtual assets license, to then replicate it in other parts of Southern Africa. And then now we're working with parts of countries in Central Africa that can use that as a case study to build out their own. And so just a kind of partnership with each regulator.
Talking about partnerships, obviously I know you have one with Visa. What does the next phase of growth look like for you in terms of your partnerships?
Yeah, we're actually in the process of, we recently just announced our expansion outside of Africa to other parts of the emerging worlds. And so what we've come to learn is this technology that we've been building out for years, it is just as much value and applies just as directly in other parts of the world. And so, our goal is to essentially bring all of these different payment networks and payment systems around the world, link them together through stablecoins. And so, we're just really getting started. Yeah.
Are you looking to go deeper in any existing markets, or is it just purely expansion into new ones?
Yeah, we're constantly getting deeper in our existing jurisdictions, so adding more and more connectivity to local banking systems and mobile money operators. But I would say right now our focus is on expanding to other regions of the world while connecting them together. So the idea is just building out this network that's constantly getting stronger and interconnected with each other.
Are there any trends or unexpected things which are happening which Yellow Card are quietly preparing for now that you'd like to share with us?
I think this is more from a kind of technology and founder perspective, but I think the adoption broadly of SaaS products so deeply into everyone's technology stack is going to be something that is going to be impacted by AI, and so that's something we've been building out as our own internal agentic framework, and have been replacing some of our in-house SaaS products with our own agentic-based systems. And the reason being is for fintech specifically, I think there's been a bit of ignorance around the scalability of unit economics, especially when you're using so many different SaaS providers. And so for us, we're trying to be very proactive in ensuring that we have unit economics to scale, and the barrier to entry to building rather than buying or outsourcing to SaaS has just been decreased substantially thanks to AI.
Very cool. I think we're about to wrap up now, and so I was going to do a quick fire, but I just got the sign. So thank you for your time, Justin, and thank you everyone for being here.
Awesome.
Terrific conversation, guys. Terrific conversation. I have to say something. If you can only imagine, and I didn't know this, but the first VASP on the continent, that is just an incredible accomplishment, first of all, to break through. All the interference you were running, all the different regulatory nonsense. Forget about MiCA.
Oh, yeah.
Forget about VARA.
Oh, yeah.
Forget about, sorry, SEC, right? But to imagine trying to figure out that mosaic and what you guys have been able to pull off, congratulations on your success, and right here in the South.
Oh, yeah.
So let's give it up, if we can, for Yellow Card.
Appreciate it.